If you want steady monthly cash flow without chasing risky double-digit yields, build a simple income plan with 3 parts: a core growth engine, a reliable income sleeve, and a short-term cash buffer. This structure lets you pay yourself every month while keeping long-term growth intact. Start by setting a clear monthly target. Pick a number that covers essentials plus a small cushion. Multiply that number by 12, then compare it to your total investable assets. If your plan requires withdrawing more than 4 to 5% per year, lower the target or extend your timeline. Sustainable beats aggressive. Part 1 is the core growth engine. Use a broad, low-cost, diversified market fund as the backbone. The goal here is long-term compounding, not income. Think of this as the part that quietly makes you wealthier in the background. Reinvest dividends in this sleeve and avoid tinkering. Let time do the heavy lifting. Part 2 is the income sleeve. This is where your monthly cash comes from. You can blend dividend-focused funds with some covered call strategies if you accept the trade-off. Higher current income but capped upside. Keep concentration in any single sector modest. Remember, simple rules win. Diversify, keep fees low, and don't chase headline yields. Part 3 is the cash buffer. Hold a few months of expenses in short-term instruments like T-bills or high-quality money market funds. This buffer smooths your cash flow so you're not forced to sell growth assets during a downturn. Refill the buffer during strong markets and draw from it when markets are weak. Put the pieces together like this. First, allocate roughly 60 to 70% to the core growth engine, 20 to 30% to the income sleeve, and the remainder to the cash buffer. Second, set up automatic monthly transfers from the income sleeve to your checking account. Third, once a quarter, rebalance gently back to target weights. If the market rallied, trim a little from winners. If it fell, use fresh contributions to buy valued assets. Now let's make it practical with quick math. Suppose you want $2,000 per month. That is $24,000 per year. If your portfolio yield across the income sleeve averages about 4%, you need roughly $600,000 allocated to that sleeve to fully cover it. Most people will blend income with core growth and let the buffer handle timing. So your actual required total may be lower. The exact split depends on risk tolerance and taxes. Speaking of taxes, remember that not all income is taxed the same. Qualified dividends may be taxed at lower rates, while some option-based income can be treated differently. Place assets thoughtfully. Tax-efficient growth in taxable accounts. Tax-heavy strategies in tax-advantaged accounts when possible. Always follow local rules and consult a professional for your situation. Risk control matters more than yield. Watch for dividend cuts, sector concentration, and strategy drift. Keep position sizes sane. Use a simple stoplight checklist each month. Green if income comfortably exceeds expenses. Yellow if you are drawing the buffer faster than you refill it. And red if you would be forced to sell core assets at a loss. When you see yellow, tighten spending or top up contributions. When you see red, pause discretionary withdrawals and rebuild the buffer. Finally, automate what you can. Schedule contributions, dividend reinvestment for growth assets, and monthly transfers from your income sleeve. The less you rely on emotion, the better your results. In short, build income the calm way, a compounding core for the future, a diversified income sleeve for today, and a short-term buffer for stability. Set the target, automate the flow, and let the plan work for you month after month. Stay tuned for the next video, where we walk through a step-by-step monthly checklist to maintain this plan in under 15 minutes, including how to rebalance and refill the cash buffer without overtrading.